When you put your hard-earned money to work, the goal is pretty simple. You want it to grow. For a long time, the stock market has been the exciting side of the playground for that growth. You take a leap, your money can jump up high, but there is always the chance it comes crashing straight back down. This image shows a physical United States savings bond. A bond is basically an official loan to a government or large company. Because you are lending money with a strict promise to get it back plus interest, bonds act as a reliable counterweight. Usually they move in opposite directions. When stock prices drop, bond prices tend to go up. By putting both in your account, you balance the ride. If one falls, the other holds steady, limiting your losses. But take a look at this red electronic display from the New York Stock Exchange. Recently, for the first time in nearly 30 years, both stocks and bonds crashed heavily at the exact same time. The safety net we rely on to protect our savings gave way, leaving retirement accounts and personal portfolios completely exposed to the mud. The numbers at the start of the year looked pretty grim. Canadian bonds fell more than 12%, and U.S. bonds dropped nearly 10%. At the same time, major stock indexes sank by nearly 30%. This is entirely backwards. The main reason financial advisors tell you to buy bonds is to act as a shock absorber for drops exactly like this. So what went wrong? Imagine a massive storm rolling in. It doesn't matter what equipment you're playing on. An external force is ruining the entire playground for everyone. The first half of that storm is high inflation. The economy is running extremely hot, and the cost of everyday things like groceries and gas is shooting up rapidly. The second half of the storm is rising interest rates. To cool down that inflation and make life affordable again, central bankers are aggressively raising the cost of borrowing money. When the cost of living surges and borrowing costs spike at the exact same time, the normal laws of financial physics stop working. As interest rates go up, plain cash in a bank vault suddenly offers an attractive, guaranteed payout. With cash paying a zero-risk reward, people avoid the unpredictable stock market. They also ignore older bonds, which no longer seem like a good deal. Looking at these scattered US dollar bills, it's clear what happened. Liquid cash temporarily became the safest haven, pulling money out of every other investment. The seesaw mechanism didn't actually snap. Investors simply walked away from the playground entirely to find shelter from the rain. If you are looking at your retirement account right now, you might wonder if bonds are useless and if it's time to abandon this strategy. But this heavy weather cannot last forever. Policymakers are actively putting measures in place to bring inflation back down to normal levels. If we look back to the high inflation of the 1980s, we see that bonds have weathered this kind of environment before, and they quickly return to their normal protective behavior. Selling your bonds right now means cashing out while prices are at the bottom. You would be permanently locking in what is likely a temporary loss. Plus, if central bankers hit the brakes too hard and slow the economy into a recession, you will absolutely want those bonds in your account to protect your money. When investing for goals that are years or decades away, the best move is often having patience to wait until the weather clears. Once inflation settles, the steady march of human productivity and innovation will take over again. The balance will perfectly restore itself, and bonds will get right back to their real job, keeping your savings safe.